Hello and welcome back. You are watching Tracking Trends. And today we are tracking the rupee, its fall in recent days, what lies ahead, more importantly, what various stakeholders have to say about it, especially the International Monetary Fund, which yesterday, that is Wednesday, came out with a new assessment for India's foreign exchange management. It said India's foreign exchange regime is a kind of crawl like pig, which means the central bank keeps intervening. And that's not what is expected of a country that claims to have a floating, flexible exchange rate regime. What does the IMF's observation mean? Where is the rupee headed? We will talk more in depth about it, and I have Venkat Thiagarajan joining me. Venkat is a veteran forex trader. He has been in the industry for more than 3 decades, spent a long time with Syndicate Bank, then moved over to Reliance Industries, where he managed their forex business. And now he has his own organization called SYFX Foundation, of which he is the chairman. Thank you, Venkat, for joining us. But before we go over to Venkat, a general reminder to subscribe to our channel. If you like it, share it with your peers and friends. And whatever we discuss here, they appear on basispointinsight.com, an exclusively policy and macro development focused portal. If you haven't subscribed to it, do that. Do subscribe to our channel, both basispointinsight.com and my personal channel, where you get to watch every episode of Tracking Trends. Venkat, let's begin by telling our audience what did the International Monetary Fund do yesterday? What does it mean for the Indian currency, the rupee, which has been slipping for the past several days? And on Friday, that is on November 21, it touched an all-time low of 89.24 and has since been under pressure. Yesterday, it kind of ended flat. But in these few days, we have also seen the RBI stepping in, the state-run banks stepping in to sell dollars and kind of prop up the rupee. Now, in light of all of these, and there is a lot of concern about where the rupee is headed, in the light of all of these, what do these IMF's new description or new assessment of India's forex rate regime mean?
Yeah, at the outset, let me first thank you very much for having me in your show. Actually, number two, that is coming to IMF reclassification. See, IMF had been classifying exchange rate regimes since 1998. Before 1998, actually, they used to go by what each country used to say about their regimes. After 1998, their staff went through the exchange rate mechanism and then possibly exchange rate history of the particular country and started classifying. There are three classifications. One is a soft peg, another is a hard peg, and third is a freely floating rate regime. Actually, normally, and from 2009 onwards, actually they changed it and to include so many varieties. Actually, now in India is officially declared policy of having a floating rate regime, where actually basically the market forces determine the parity of rupee vis-a-vis other currencies. But since 1994, actually, to 20th August 1994, we signed the IMF Charter, and then from then onwards, actually, we have been following this floating rate regime. Actually, yes, emerging market currencies normally, actually, they are recipients of global capital, and then actually the central banks normally they fear floating, And more than that, they fear declaring. That is why actually fear of floating and fear of declaring, actually those two phrases came into prominence. Nearly about 20 years since 1994, or possibly 25 years, we have been having a system in which actually where actually the international capital cycle, our own domestic business cycle, all these things determine the rupee actually. So to a large extent, if a layman who is participating in the exchange rate market, or for a seasoned investor, he is able to easily predict or have some visibility over where the exchange rate will go based on the macro forces. Let it be economic, let it be seasonal, let it be exports, imports, actually, monetary policy differential, interest rate differentials, productivity differentials, all sorts of economic parameters. You can have a fairly good idea about where the dollar rupee or where the exchange rate will go. After 2009, actually, or 2019, there is a subtle change in the entire exchange rate regime. That is what we see in the market, actually. So basically, the stability has been given more prominence, and actually that is why actually there has been periods when actually dollar rupee used to be trading in, let's say, 5 paisa. Actually we are talking about dollar rupee basically because that is the predominantly the exchange rate that normally the markets follow. So very small ranges. So basically, then what happened 2022 to 2024, dollar rupee has shifted from floating rate regime to stabilized regime. That is what February 25 IMF classification showed. So one
No,
step lower.
just hold your thought there. Uh, just that our audience doesn't get lost. Basically, what Venkat has explained, uh, prior to 1994, or rather before the economic liberalization process began in 1991, we had a fixed exchange rate regime where the central bank fixed the for dollar rate of rupee or the rupee value of dollar. Okay, and from time to time they revisited and changed it, and that was actually often seen as the root cause of why India's economic system was not seen as an attractive system for the foreign capital, because global capital favors to go into countries that have flexible exchange rate regime. Am I right, Venkat?
Yeah, yeah.
Yeah. And
Hmm.
then, so in 1994, we signed this agreement with International Monetary Fund, and we thereafter declare that we are a floating or flexible exchange rate system where market forces, driven by various other parameters that Venkat explained, inflation rate, export performance, productivity levels, there's a myriad number of factors, global inflows, foreign investment inflows, blah, 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 they impact where rupee would trade against dollar. And by and large, that system, uh, we took it, I mean, that system should be seen as a flexible exchange rate system. But here lies the issue with emerging economies like India. We say that it's a flexible exchange rate system, but as Venkat has mentioned in his article, what we do has been a little different, which is we keep intervening in the market through our central bank and keep supporting our currencies whenever we fear that it may kind of get into a territory of volatility or a slide that could be detrimental to our overall economic interests. And that's why IMF started introducing within these the two new categories, which is a hard peg and a soft peg. And again, within the soft peg, in 2009, they introduced further categorization, which is a
Yeah.
stabilized regime and a soft peg. In 2023, what the International Monetary Fund did, it said the India's central bank is intervening in the foreign exchange market too frequently and too intensely. And what is it is doing, it is managing the stability of the rupee, or it is managing a stabilized forex regime rather than a fully flexible forex regime. And now it is kind of added another observation. Now my question to you, Venkat, is this
Hmm.
yesterday's scroll like peg, what does it mean actually, and is it a downgrade or is it just another adverse observation?
See, we cannot subjectively determine actually whether it is an upgrade or downgrade actually. The only thing
It's
is,
an observation.
It's an observation, actually, as simple as this. So basically, all the emerging markets do intervene in the forex market. It is not that no emerging market should intervene in the forex market. That is not the issue. The only thing is how frequently, how how seriously you are intervening. You just take January 24 to December 24. Actually, I'm just taking a saying. This 12 months period, the central bank has bought, that is, has bought dollar rupee to the extent of 24 billion on an average in every month, and sold about $25 billion average in every month. And then is the top of the chart was December 2024, and then they had some $60 billion of buy and $49 billion of sell, something like that actually. So basically, when you are almost more than 25% of the market, that means you are intervening excessively.
Excessively.
That is one point. So why do we actually what we have achieved? The exports are there at the same level. Actually, it is not that export competitiveness that has gone up basically because you have protected dollar rupee from falling, or vice versa. Actually, just because the dollar rupee has gone up, the imports have come down. Nothing like that. Now, $42 billion trade deficit you are seeing on your own eyes. So basically, when you are protecting an exchange rate from moving too quickly on either side, you are enabling inefficient capital allocation. That's a basic point, actually. Now, take for instance the October trade data. Actually, net trade deficit was $41.68 billion,
Yeah.
out of which $14 billion was a gold imports. So basically, when the dollar rupee was being held under check at 88.80, where actually RBI was selling dollars, of course, we all know they were selling the dollars. Of course, there is no confirmation of that. Anyway, when there was a heavy protection at 88.80, and then when your gold imports are going higher, phenomenally higher by $14 billion in October. Okay, basically festive demand, okay, bidding demand and all that stuff. Anyway, that is a inefficient allocation of capital. As simple as this. This capital could have gone anywhere else in the economy, but it went into the deploying in gold, actually, basically, because we all know it is a inefficient capital allocation. So when you hold the exchange rate in some sort of a caged bird model, you are enabling inefficient capital allocation. That impacts the entire economy, actually. Basically, you can very well say basically we are insulated, we are a domestic economy, we don't have anything to do with the global economy. Yes, yes, all agreed. But then at the end of it, when you are following inflation targeting monetary policy, you are supposed to be having a flexible floating rate regime in order to facilitate inflation targeting monetary policy. It is like just like
Can you explain that? I like the word cased bird. You use that in the headline for the article you wrote in
yes.
basic.inside.com. But you do explain in that article about how it complicates inflation targeting. When you do intervene like this. But can you explain that why? When you have an inflation targeting monetary policy, why it is important that you play by the spirit of a flexible foreign exchange rate regime? Why?
See,
How are the
basic, See, there are three things that most of the countries are supposed to have. One is a flexible exchange rate policy. Another is monetary policy independence, and third is that is independence of central bank. Actually, monetary policy independence, independence of central bank, and then flexible exchange rate policy. These are all the three things that go together actually. When you are having a flexible exchange rate policy, it is as good as actually analogy. I will tell you, it is as good as taking a allopathic medicine. And then when you are having a fixed rate or a soft peg or a hard peg, it is just like a Ayurvedic medicine. Both the things may counteract each other. Both the things may supplement each other, but it is always seen whenever you are following a flexible, that is, inflation targeting monetary policy, you are supposed to be following a flexible and floating exchange rate policy. This is actually laid down rule, as simple as this. Now,
Hmm.
what we are doing, we are following a inflation targeting monetary policy. At the same time, we are following some sort of a caged bird exchange rate policy, where actually I will not let the dollar rupee go down or let the dollar rupee go up, and I will hold it in 5 paisa range for the day. Thankfully, actually nowadays actually it has become 30 paisa range. Actually, that is why what has happened. Actually, basically, you have been trading between 88.30 to 88.80. From 88.80, you broke, and then 89.30. So this 30 pizza range, and on a ladder approach, actually, as we go higher and higher and higher, maybe the policy should be
Yeah,
most.
we will show that in a graphic wherein actually through this year how that band has kept shifting on a horizontal axis rightward. I mean, exactly bears out what what you're saying.
Yeah. So basically, we are step by step in the ladder approach we are going. Possibly the policy could be that is, I will go on depreciating the currency. Basically, because we are full on monetary policy, we are full on fiscal policy. So exchange rate policy is the only lever through which I can stimulate the economy. So I will go on stimulating the economy through the exchange rate policy. Possibly that could be one of the reasons. My point is, we have chosen floating rate policy. Whenever we are deviating from that policy, why not you come out public with the communication saying that, okay, we are watching what is happening in the dollar rupee market? A simple sentence like that. Possibly it will give more confidence to the market participants. That's a basic point, actually. Now, right now, if you let us assume that you are an exporter. What is your foreign exchange management hedging policy right now? Absolutely, you don't know, because it is all the wherever RBI takes it. You just ask any bank, they will say wherever RBI takes it, actually that will be the exchange rate that will accrue to you at the time of realization of your exports. So if you are cost conscious, basically every exporter works on 5% margin or 6% margin. The margins are lower, and of course, in this tariff world, actually margins are not there. So I should know, at least I should have some visibility of the exchange rate. If you allow market forces or macro forces to play around, okay, I can have a very good idea about what are the kind of macro forces that are going to operate, and I can position myself accordingly. Right now, the exporters and importers, everybody is in the dark. When the 88.80 broke on Friday, actually the hell broke loose amongst the exporter importer community. Basically, we don't know where it is going to go. People are not talking about 90, 95. Everybody will talk, actually. Basically, next level, what is the next level? And for people who talk about the levels, for them, actually, it doesn't hit their bottom line. For actually guy who is there in the grassroots level as an exporter importer, for him actually his margins are hit. So that is what I am asking. Basically, whenever, okay, fair enough. Actually, it could be on account of various other reasons. Actually, basically, dollar rupee has been made to do what it is doing. But why not let us communicate? Okay, fair enough. Actually, basically, when there is a confidence, a communication will always follow. Okay, we are watching. We actually, what is the kind of policy changes that we are implementing? What is the choice of policy that we have had? Floating exchange rate policy. What is the practice that we are doing? Caged exchange rate policy. Why this divergence between the choice and the practice? At least let somebody come out and say for sure, okay, and then assure the entire community, actually, basically, there is something, actually everybody is watching. It is not that now actually we are all actually mostly all the participants are mechanically thinking. Now once 89.30 breaks, then the next 30 paisa range will come in. So 89.30, 89.60, there it will consolidate for a long time, and before it goes higher, actually. So this is what is market thinking, actually.
So
So
where is the rupee headed? If I were to ask, will it cross 90 now? Will it fall beyond 90?
yeah, basically, when you are not allowing any macro forces to play, when the dollar cycle to play, global financial cycle to play, and then you are using the exchange rate as some sort of a monetary anchor at times and fiscal anchor at times. So it is tough to forecast where dollar rupee will go for that matter. Actually,
But
I can very well say.
suppose tomorrow RBI stops intervening. RBI
Yeah,
stops propping up the rupee. Where
so
do you
basically,
think
people
actually the rupee should be going?
maybe actually a week back, if you had asked me, actually they told actually 8880 is a China wall, it cannot
Hmm,
be broken.
hmm,
But now over that it has broken. Actually, it had gone all the way up to 18 and a half.
hmm,
And then one can be very well sure some 30 paisa range, that is stability on lack of volatility in that particular range. Just now,
hmm,
yesterday, you see it was trading between 20 and 30 for a quite a
hmm,
long time.
hmm, hmm, hmm,
So intraday volatility will be controlled,
hmm, hmm,
and then it is strangulated in the range.
hmm.
And then a depreciating bias, rupee depreciation bias is evident in the entire scheme of things. So if you
Okay.
take all these things, possibly actually we will slowly move into the early 90s. Yes, possible. If there is a change in thinking, and then if they allow the market forces to determine where the dollar rupee is going to go, then naturally, possibly it can come down. Actually, that is why actually there is a big if. It all revolves around the thinking in the mainstream.
Hmm.
Otherwise, actually, basically, scientifically or objectively, you cannot forecast where the dollar rupee will go in the next 1 to 2 months.
Hmm. But if one were to see the shift in that band over the last 1 year, and if it kind of maintains that pattern, so nothing changes, that is ceteris paribus. So it would be fair to see from there that in about 4 to 6 weeks, surely you could be in a range which is beyond 90, right?
Yeah, yeah, absolutely. See, basically, right now,
You are
actually,
saying, but you are saying if you do not intervene, if you allow market forces to play, then would the rupee go down further, or the rupee can actually come back because there will be more clarity and better?
see, basically, given the fact that if it is almost going to cut in December, and then and then there is some sort of a dollar down move that is happening across the world. So basically, that will echo in dollar rupee as well. Actually, that used to be the case, let's say, pre 2019 days, actually, or even pre 2022 days, actually. So basically, dollar cycle will have a reflection on the dollar rupee as well. Emerging market currencies, those currencies also actually it will have an impact on the dollar rupee. So global forces and macro forces will play a big role in determining where the dollar rupee exchange rate will go. So
Hmm.
given the current situation, possibly actually if today hypothetically if we have to assume that the RBI takes a hand off the table, possibly we will see dollar rupee coming down actually.
Hmm. 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 So
Basically, now the question is not the flows, not the other important factors. It is basically the credibility and the confidence. Basically, people think if it comes to 88, 80, he will come on the bid. That's a basic idea actually.
hmm, hmm, hmm.
He will not
Very
allow me to
important.
go down.
It's a
If I
question
sell
of
dollar, if I
it's a
sell
question
dollar,
of credibility and confidence. Those are very
yeah, yeah,
important
yeah,
words
yeah,
you use.
absolutely. See, the
And
credibility and trust makes the exchange rate actually as simple as that. Now actually the predominantly the market saying actually Dolby will be playing on both sides. That is why this caged bird exchange rate policy that is causing more harm than good actually. You have not seen exports going dramatically higher basically because of a depreciated currency. Yeah, it didn't happen.
Mhm. I remember you were saying that if you just said everyone is watching. I remember covering YV Reddy. When YV Reddy was the deputy governor and then subsequently RBI governor. I don't know about your views, but I think he used to do this very brilliantly. At the right time, he would say a few words, and the market got the message.
Yeah,
And
yeah,
uh, and he used to always say it is important to have orderly conditions in the
yeah,
market.
yeah.
And yeah.
That is why Fed speaks, ECB speaks, and then actually basically RBI should be seen more speaking in actually basically if he speaks actually it will give a lot of confidence to
Right,
all of us actually.
right, right. Now, tell me, in the first week of December, now the Monetary Policy Committee meets, and there is now expectation that they might go for another round of repo rate cut. Now, that will add to pressure on rupee, won't it? If there is a
See
rate cut.
basically conventionally people think interest rate differentials are determining exchange rate actually. In my view, actually, that is a old book actually, as simple as this, old thought actually. Now, actually, basically, innovation differentials they are determining where the exchange rate is headed. Actually,
Mm-hmm.
innovation differentials in the sense, let us say AA differential.
Mm.
Of course, the flavor of the season is AA differential. If US is very strong in AA and China is very strong in AA, naturally you see both the currencies appreciating. Europe is
Okay.
not that strong in AI. Actually, basically, it is a laggard. Even ECB Lagarde also talked about
Mm.
Europe lagging behind in AI. Actually. So basically, now the market has gone beyond interest rate differentials. Actually, it is
Okay.
not. It is
Yes.
not. If you are going to cut, Fed is going to cut on the week after next. So it is not going to matter much. Actually, the only
Okay.
thing is you bring credibility to the table. Actually, even now, actually, why people are afraid about a politicization of Fed,
Right.
basically because credibility will go. That's a basic apprehension. That is why dollar got sold off yesterday.
Very true.
So right now, actually, we want credibility to actually you do anything. Actually, absolutely. Actually, basically, we also built reserves from nowhere to $270 billion in the period between 1998 to 2012. So at the time, nobody watched, nobody was very serious about the intervention tactics. Now, actually, we are actually post 2019. Now it has become some sort of a regular habit to both defend the downside as well as the upside, actually, and then keep it in a cage. And now that is what is called a crawling arrangement right now by IMF. So it is not going to change the pattern, or actually, it is not going to change the system anyway. I think we are going to continue with the system. The only the request is actually let there be open communication with the market at every given point of time.
Mm. So, coming back, you were harping on this credibility and confidence. Now, the IMF, you said it's an observation. You cannot call it, use a tag called downgrade or anything.
Yeah, yeah,
But
absolutely.
the fact remains that in 2023, you were recognized as a floating exchange rate system. When IMF came up with this observation, it actually essentially moved you out of that recognition that you are a pure play flexible exchange rate regime. Now, 2 years down the line, the expectation would have been, if we are doing so well, and if the global economy, global capital, as we are told day in day out, that India is emerging as an economic power, global capital is so keen to come here, everybody is taking note of what we are doing, then ideally the expectation would have been that this additional tag, that observation that IMF made, they should have removed it 2 years down the line. They stayed with it last year, they did not touch it. They insisted that we will watch you for one more year. And after watching for one more year, they have again made an observation, which is not an encouraging observation. Now, that also affects the credibility and confidence, won't it? When an organization like, RBI may brush aside that observation, our government may brush aside that observation, but International Monetary Fund is International Monetary Fund. Somewhere,
Yeah,
some people would be taking note of it, right?
yeah, yeah. So global investors normally go into countries where actually floating rate regime is present. Actually, basically, I told you earlier itself. So it presents me as some sort of a visibility. Basically, I am putting money in your country. Naturally, I get some sort of a visibility where it will be after a year or so that I can be rest assured that my money would be safe, something like that. Actually, now actually it all revolves around what is the thinking in the main street, as simple as this. And now people are actually come around to believe actually the 4% depreciation on a year-on-year basis, 4% rupee depreciation on a year-on-year basis is a given thing.
Yeah.
Is a given thing actually. Basically, that is what has happened in the last one. So till 2022, we were recognized as floating rate regime by the IMF. Going by the practices between 2022 and 2024, they classified as stabilized in February 2025. Within a matter of 9 months, actually, we started being classified as a crawling arrangement. One can argue actually crawling arrangement is a better version of stabilized
Yeah.
actually. Basically, in stabilized you didn't give even a 5 paisa movement. Crawling arrangement you are giving a 30 paisa movement. This can actually you can take heart from it. But crawling arrangement or stabilized, it just suggests that somebody other than me is calling shots as far as the exchange rate is concerned.
Yeah. Yeah.
I can go wrong or right in my exchange rate prediction. But when I put money, I will have visibility. Now, global investors, they will try to choose current countries and currencies with floating rate regimes rather than coming to countries with crawling arrangement or countries with the stabilized. Whatever stability and lack of volatility you are sure, they will be more interested in countries where actually floating rate regime purchased. That is
Mm.
why possibly, actually, it is a really a coincidence that post 2025 February, you have seen a deceleration in flows, maybe because of this.
22. 22. You
No,
said
actually,
20. February
February
2025.
February 2025, the classification into stabilized came.
Yeah.
Before that, officially, we were a floating rate regime.
Mhm. Didn't
See,
it happen in 2023?
no. Actually, they observed between February 2022 and 2024, they came with the classification as stabilized in February 2025.
Okay. 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 Okay.
And then coincidentally, it can be coincidental that the flows have decelerated both into the equity space as well as the fixed income space, and then FDI also decelerated post February 2025. Maybe it is only a coincidence. It is not because of the classification it has happened. It can be a coincidence. So basically, this classification into crawling arrangement may only dampen the sentiments of the global investors going by what has happened between February 2025 till November 2025.
Mhm. So what happens to the dollar returns of foreign investors? What should they expect going forward?
Dollar returns of the foreign investors as far as
Investors
equity
in India.
markets are concerned or a fixed income is concerned.
Both. Both.
So fixed income we are having 6.5% actually basically at the end of it he has to let us say he has to borrow at 4.5%. Actually 4.5% you won't get actually dollar. Even a
Hmm.
hedge fund normally for borrows at 5% and he hedges at 1 year hedge cost is let's say 2% in 2.20% as far as the dollar rupee is concerned. His total landed cost is around 7.25% actually.
Hmm.
If he chooses to deploy in let's say 10-year GSEC, he is going to just get 6.5%. Naturally, he is not going to be. It is not a wise game as such. So basically, they invest in risky assets actually. And risky assets are maybe actually, let us say corporate bonds or maybe real estate or so on and so forth. So right now, actually, as the interest rate differentials compress, basically as the dollar interest rate, dollar rates are higher and the rupee rates are lower, naturally this kind of arbitrage flows that doesn't happen actually. That's the point actually. So as far as equities is concerned, actually, unless your equity market is going to deliver a 20% return, actually, it doesn't make any sense for them to take a dollar rupee risk. Actually, he is going to lose 4% on dollar rupee year on year. Correct? Actually, basically, that is the assumption that which we are going. 4%, and then landed cost is let us say 7%. So naturally, it is what about 11% is this cost, whereas 20% return is what you would expect. So that is why actually our markets are bit struggling. Actually, nothing more than actually struggling to attract overseas capital. Actually, nothing more than that.
My last question: if you were the
Yeah.
RBI governor or the finance minister of the country,
Oh God.
what would you do?
Is hypothetical. Anyway, actually, I wish I am not actually. The basic thing is actually let us release this bird. And
Yeah.
what is going to happen actually? We are very, very confident country here. We are growing at 8% year, okay, 7.5%, not 7% year on year. Actually, we are
Mm,
a confident country. There are countries. It is not that there is going to be a foreign exchange crisis just because that you are going to let the dollar rupee go around. Actually,
mm,
let it go around. Actually, in the pursuit of volatility, that is actually arresting volatility and ensuring stability, we have given up our life. It
mm.
is basically let some life breathe into the exchange rate. Actually,
Okay.
so
That's
basically it is not the once you allow the exchange rate to move around freely, naturally the foreign capital actually which is waiting in the wings, and basically they are all worried about the exchange rate policy. Actually, nothing more than that.
mm,
Basically,
mm,
when I am putting money in the in any country, I am also looking for some forex gains.
mm,
If you don't allow me to take any forex gain, and if you think that is not acceptable, I'm
mm,
sorry. Actually, we are living in a world where actually there's a excessive financial integration. So
mm,
capital chases where the opportunities are. So
mm,
when you want to get the capital, you have to provide opportunities.
mm,
So you allow the dollar rupee to go around. Actually, if you are just hypothetically, we will assume that there has been a hands-off approach of RBI right
mm.
from let's say 2022 onwards in the last 3 years, where dollar rupee would have been.
Okay, so let's breathe some life into the forex regime. Let's focus on what really matters, which is credibility and confidence of your forex regime and the people who manage it, which means that we should stop intervening the way we have been. The RBI should, in pursuit of controlling volatility, resist the idea of frequent intervention in the forex market, trying to prop up the rupee through dollar sales, or even for a future dollar sales, keep buying dollars from the market. The government should also resist from probably, guiding state-run banks to do dollar sales to prop up the rupee. Let rupee and dollar find their true value through the market forces. Let rupee, which Venkat likes to call in its current state a caged bird, let's release that bird, let's make it free, and let's bring back the reputation of India as being actually a flexible exchange rate regime, which would only be in the longer term prove to be good for everything that we want to get by integrating ourselves in the global financial system. Thank you, Venkat, for your time, and we hope to have this conversation again. And to our audience, I'll be posting the links if those who want to dive deeper into the issue. The piece that Venkat has written, a brilliant piece by my colleague Kalyan Ram at Basis Point. All those links will be available in this video. And keep coming back to us. Again, as I said, share, subscribe, and keep talking about our channel. Thank you.